Welcome to this Bell Direct weekly update. I'm Julia Lee, an equity strategist with Bell Direct. And unfortunately, this month in September, it looks like it's turning out to be the first negative month for the Australian share market in 6 months. And given that, we're seeing a lot of the brokers trying to work out when the next downturn in terms of the market will be. So starting off with Morgan Stanley and US equity strategy, given that it's the US stock market that's been dictating global returns throughout the last couple of years. Morgan Stanley is saying that it expects year-on-year earnings growth to peak in the second quarter or the third quarter, saying that fourth quarter comparisons are tough due to last year's hurricane relief as well as tax reform benefits. What it sees is vulnerable is US tech, discretionary as well as small caps, and it does favor value over growth at this part of the cycle. Despite calling for a coming cyclical consolidation, it still though believes in a secular bull market and in the longer term is positive. It thinks that this year, 2018, marks the beginning of a wide trading range that will last for several years. Having a look now at the resources space, and we'll start off with Macquarie looking at Australian iron ore miners, saying volumes are to fall in the September quarter. Shipments from key WA ports have declined around about 100 million tonnes per annum from the June peak, with BHP Billiton, Rio Tinto and Fortescue all seeing reductions in shipping rates. They have cut their shipping rate for Fortescue and Rio Tinto this financial year by around 2 million tonnes per annum to reflect that weaker shipping rate in the September quarter. They do retain their preference for BHP over Rio due to its superior earnings upgrade momentum, while Fortescue is trading below its spot price valuation. Moving on to Shaw and the energy space. The lack of investment into critical supply regions is supporting prices, according to Shaw. They say that there's no sign of a slowdown in demand, but they are cautious on the domestic gas industry as the rising risk of regulatory as well as government interference occurs in the space. They have a buy on Woodside Petroleum with a target of $39 and Oil Search with the target of $8.70. They are avoiding those gas plays that are exposed to the domestic market, including Santos as well as Beach Petroleum. Staying with resources, and this time lithium, Morgan Stanley are bears on lithium. Their bear lithium thesis remains, and it's based on their expectation that new supply will come from large, experienced and low-cost global players like SQB and ALB. Despite the delays faced, new projects are addressing the tight lithium market, and spot prices have plunged from the peak that we saw in mid-March. They do see ALB as the best way to play the theme if investors wish to do so. Having a look at some stock calls from Morgans, and they like CBA with an ad. In fact, they like banks. They believe dividend yields are robust, cost reduction is set to become a key theme, and reduction in regulatory risk to continue over the next 12 months. They have an ad on Commonwealth Bank, however, Westpac and NAB are their preferred banks in the space. They have a hold on Wesfarmers, but an ad on Oz Minerals, saying it's time to accumulate Oz Minerals. The market dramatically underappreciating Oz Minerals valuation uplift as Carrapateena transitions from peak capex to substantial cash generation from 2021 onwards. They also like BHP, saying it's spewing cash. There's plenty of reasons for the good times to continue, both on a market and company level, and also an ad on Reliance Worldwide, saying there's still plenty in the pipeline. So plenty happening in terms of the market, especially with the added volatility over the last couple of weeks. The Australian share market, though, looking to end slightly higher for the week, but we have seen increased volatility, one of the themes on the market. I'm Julia Lee, an equity strategist from Bell Direct. Hope to see you next week.